September 15th, 2008. Early morning in New York City. Lights on, empty hallways, cardboard boxes in people's hands. In silence, employees leave the building. Inside, the decision has already been made. The Lehman Brothers bankruptcy is official. When the markets open, the bomb goes off. The Lehman Brothers collapse shakes Wall Street in 2008. Stocks plunge, phones don't stop ringing. What looked like a market adjustment reveals what it really was: the first visible stage of the 2008 financial crisis, fueled by years of easy credit, a housing bubble, and the subprime crisis. In a single day, the world realizes that the global financial system is not indestructible. And one question hangs in the air: how did they let it go this far? To understand that silent early morning in New York, with Lehman Brothers employees walking out with their heads down, we need to go back a few years. The Lehman Brothers collapse did not start on September 15, 2008. In reality, that was just the moment when a mechanism that had been spinning at its limit for a long time finally snapped. Before the collapse, there was euphoria. In the early 2000s, after the dot-com bubble burst and the 9/11 attacks, central banks, especially in the United States, cut interest rates to historically low levels. Cheap money, easy credit. It was like opening the tap of the financial system and saying, "Drink as much as you want." In that environment, the 2008 housing market started to inflate like a balloon. Houses were being bought, sold, refinanced. Almost anyone could get a loan. And that's where the heart of the subprime crisis is born. Subprime mortgages were loans granted to people with poor credit histories, unstable income, or weak documentation. Under normal conditions, these borrowers would be seen as high risk. But in the middle of the euphoria, the reasoning was different. No problem. Housing prices only go up. If they don't pay, the house is still worth more. The illusion was simple and dangerous, believing the housing bubble had no limit. The investment banks, like Lehman Brothers, weren't just lending money. They were turning these mortgages into sophisticated financial products. Bundles of loans were grouped, sliced, and sold around the world as highly profitable securities. The promise? Higher yields, with controlled risk. On top of that, a true paper architecture was built: CDOs, MBS, derivatives, credit insurance. A complex web that most people didn't fully understand, even while investing in it. Behind the curtain, the mechanism worked more or less like this: dubious quality mortgages, packaged into securities, blessed by rating agencies with high grades, distributed to funds, banks, and institutions all over the world. On the surface, it seemed brilliant. At the foundation, it was quicksand. On Wall Street in 2008, the dominant logic was leverage, using debt to multiply gains. The more housing prices rose, the safer these assets seemed, and the more banks loaded up on debt to buy even more securities tied to real estate. The gears of the global financial system spun at an ever faster pace. Anyone who dared to question it was seen as a pessimist, outdated, someone who doesn't get the new financial economy. In the economic archives of that time, if you look closely, you'll find one word appearing frequently: innovation. The investment banks saw themselves as risk engineers, able to turn fragile debts into top-tier products. And there was a crucial detail: a large share of these securities was spread across insurers, pension funds, foreign banks, local governments. No one really knew who would be holding what when the music stopped.
Meanwhile, ordinary people only saw the surface. Easy credit, apparently low interest rates, aggressive financing offers, brokers knocking on doors selling the house of your dreams. Millions of families took on debts that only seemed sustainable as long as housing prices kept rising. It was the construction of a gigantic castle, but with its foundation resting on a single pillar: the belief that the housing market would never fall. But biblically speaking, every house built on sand, sooner or later, is tested by the storm. At the same time, regulators and governments were also part of the equation.
In the preceding decades, several safeguards were loosened. Rules that separated commercial banking activities from investment banking were gradually relaxed, creating room for financial institutions to grow in both size and risk. Faith in market self-regulation was almost religious, the belief that, in order not to destroy the system they depended on, financial players would naturally restrain themselves. The 2008 crisis would show just how naive that confidence was. Meanwhile, profits were exploding. Million-dollar bonuses, ever more aggressive targets, pressure for quarterly results. Many inside the institutions sensed that something smelled wrong, but the machine rewarded those who kept pushing it forward. And so, silently, a future global economic crisis was being prepared. When the first families began to fall behind on their mortgage payments, it still seemed manageable. A few foreclosures, some repossessed homes, a bit of adjustment. But the isolated cracks in the 2008 housing market started to spread. Suddenly, securities that had seemed solid were being questioned. If the mortgages at the base of the system were not worth what the model said, then the complex packages built on top of them might not be worth it either. It's at this point that the subprime crisis starts to gradually morph into the 2008 financial crisis. What had been considered mere sector instability begins to be seen as a potential financial collapse. But one element was still missing: the visible trigger that would wake the entire world up. That trigger had a first and last name: Lehman Brothers. But before we talk about the fall, we need to understand the roots. Because Lehman wasn't just a victim of the environment, it was one of the protagonists of the expansion, one of the engines that accelerated this runaway train. To see that, we have to go further back in time, to when Lehman Brothers had no idea it would one day become synonymous with the 2008 financial crisis. Long before it became the ultimate symbol of the 2008 financial crisis, Lehman Brothers was born small, almost invisible, far from the glass skyscrapers of Wall Street 2008. Mid-19th century, not in New York, but in Montgomery, Alabama. 3 German Jewish brothers, Henry, Emmanuel, and Meyer Lehman, arrive in America looking for something simple: to survive, trade, and build a life in a growing country. They start with a small, dry goods store, but they quickly notice a crucial detail. In that land, the real currency wasn't just dollars, it was cotton. The American South was living the peak of the cotton economy, built on plantations and slavery. Cotton was the white gold of the time. It fed textile factories in Europe, moved ports, and generated fortunes. The Lehman Brothers, paying attention, make a strategic move. They stop being just shopkeepers and start accepting bales of cotton as payment. Without realizing it, they begin acting as intermediaries between producers and buyers. The small store turns into a commercial bridge. That's where the seed of the future investment bank begins to be planted. Over time, Lehman starts financing producers, advancing funds, organizing the shipment of goods to other states, and even abroad. In practice, it takes on credit risk, intermediates capital, and connects supply and demand. These are the typical functions of what, decades later, would become the modern financial market. The institution is born, therefore, tied to the raw logic of American capitalism: territorial expansion, agricultural exploitation, and concentration of wealth. When the Civil War breaks out, 1861 to 1865, cotton loses stability, and the Southern economic system goes into shock. But unlike many that go under, Lehman Brothers adapts. The firm gradually shifts its focus, moves its base to New York, and draws closer to the country's financial decision-making centers. The transition from cotton to capital is symbolic. The raw material of the business ceases to be the white fiber of the fields and becomes money, credit, and securities. At the end of the 19th century and beginning of the 20th, the United States enters a phase of accelerated industrialization: railroads, steel, oil, electricity. The big conglomerates require large-scale financing. Lehman Brothers joins this movement, taking part in stock and bond offerings, connecting companies to investors. Little by little, it ceases to be a regional house and becomes a relevant player in the growing universe of investment banks. If you open the economic archives from that era, you'll find the Lehman name tied to strategic sectors: transportation, energy, major industries. The logic is always the same. Where there is expansion, there is a need for capital. Where there is capital, there is room for intermediaries. And Lehman was increasingly one of those intermediaries. In the early 20th century, the American financial system was still relatively fragmented, with recurring banking crises. The creation of the Federal Reserve in 1913 begins to structure a central bank, but the environment remains volatile. Lehman lives through World War I, the 1920s, and even the global economic crisis of 1929. In that period, Wall Street discovers the power of mass speculation. Millions enter the stock market. Leverage and excessive optimism mix again, a pattern we will later see repeated in the 2008 crisis. The Great Depression brings a strong regulatory response. Among the laws passed is the Glass-Steagall Act, 1933, which creates a clear separation between commercial banks and investment banks. Lehman Brothers solidifies itself on the investment side. This regulatory detail will shape the sector's behavior for decades, and its later reversal will help pave the way for the collapse tied to the subprime crisis.
In the post-war era, the United States emerges as a hegemonic power. The Marshall Plan, Europe's reconstruction, the Cold War, the technological race, all of this demands enormous volumes of capital. Lehman Brothers rides that wave, helping finance companies create new financial products and expand markets. The 1950s bring steady growth. The 60s and 70s, in turn, bring inflation, oil shocks, and turbulence. Over that period, the internal culture of large financial institutions begins to change. The focus slowly shifts from long-term client relationships to the pursuit of fast, competitive returns. Profit pressure grows. The traditional investment bank, centered on strategic advice and securities offerings, starts to incorporate increasingly sophisticated elements: derivatives, currency operations, market arbitrage. In the 1980s, this process accelerates dramatically. It's the era of deregulation, yuppies, and financialization. Governments reduce controls, loosen barriers, and encourage financial innovation. The dominant belief, free markets with minimal intervention, will allocate resources efficiently. In practice, it means giving investment banks more freedom to use leverage and take on larger risks. Lehman Brothers, once respectable but not top tier, enters this new phase seeking relevance. Mergers, acquisitions, internal reorganizations, all aimed at competing with giants like Goldman Sachs, Morgan Stanley, and Merrill Lynch. In 1994, Lehman becomes independent again after being spun off from American Express. A fresh start. But it's a fresh start in a different world. Lower interest rates, capital globalization, deregulation, and faith in risk engineering create the perfect environment for the next phase: mortgages and the housing bubble that would give rise to the subprime crisis. Behind the scenes, a silent shift occurs. Mathematicians, physicists, engineers, programmers, the quants, fill the banks. Advanced models prove that risks are controlled. Confidence grows. Competition intensifies. And the pursuit of profit pushes institutions toward ever greater exposure. Lehman Brothers, under pressure to grow, adopts aggressive strategies tied to the 2008 housing market. Mortgages, mortgage-backed securities, and derivatives tied to these portfolios occupy an increasingly large share of its balance sheet. The path that began in a small cotton shop in Alabama now leads to a fully global institution. Before, the valuable commodity was cotton. Later, big industry.
Now, it was mortgages. But this time, the risk was no longer local, it was global. Products tied to US mortgage credit were packaged, sliced, repackaged, and spread across the world. Pension funds in Europe, banks in Asia, global insurers, all were exposed. And with that, a troubling pattern emerges. Every time the system finds its star asset, cotton, stocks, tech, real estate, leverage grows, optimism inflates, expectations rise, until something bursts. At the turn of the 2000s, Lehman Brothers looked modern, competitive, integrated into global capital flows. Reports were confident, bonuses were massive, but beneath the surface, cracks were forming. Lehman's story was no longer just about a single institution. It was part of a machine built on cheap credit, deregulation, financial innovation, and blind faith in self-regulation. And when this machine began to spin too fast, fueled by profit hunger in the 2008 housing market, Lehman moved from its origins phase into its phase of ascent. The moment when everyone believed the numbers were unbeatable, profits were unstoppable, and no one wanted to be the voice asking, "What if this goes wrong?"
When Lehman Brothers becomes independent again in 1994, it is nowhere near the brightest star in New York. But that is exactly what ignites its ambition. On Wall Street in 2008, surviving is not enough. You need to grow, stand out, dominate. And over the next decade, Lehman chooses a very clear path to do that. Bet heavily on the 2008 housing market. The man who personifies this phase is Richard Fuld, the CEO, a central figure in the narrative of the 2008 financial crisis. Inside the institution, he earns nicknames like the Gorilla because of his aggressive, competitive, relentless style. Under his leadership, the strategic message is simple: grow faster than other investment banks, gain market share, boost profitability. The housing sector, heated by low interest rates and abundant credit, seemed like the perfect vehicle for that. To understand the ascent, we need to look at the macro picture. After the dot-com bubble burst in the early 2000s, the Federal Reserve slashed interest rates aggressively. The idea was to stimulate the economy and avoid a prolonged recession. In practice, this made credit cheap and abundant. Add to this another global movement, the so-called excess savings, from countries like China, oil exporters, and major exporters in general, which poured into US securities. The result? A glut of money chasing returns. That sea of global liquidity spilled into the housing sector. Buying a home became almost a natural right. Refinancing a mortgage to consume more became routine. Brokers pushed loans, developers expanded projects, families took on debt believing that housing prices would only go up. The housing bubble inflated silently, while politicians celebrated the dream of home ownership, and the market praised the sophistication of financial engineering. It's in this environment that Lehman Brothers is transformed. It doesn't limit itself to financing traditional mortgages. The firm dives deep into the securitization game. In simple terms, thousands of mortgages, including low-quality, subprime ones, are pooled and turned into tradable securities, the famous MBS. These, in turn, are repackaged into more complex structures, like CDOs. The pitch is always seductive. Transform risky credit into securities that look safe, often with high ratings from the rating agencies. Inside Lehman, this becomes a core business. The more mortgages are originated, the more raw material there is to securitize. The more securities are created, the more fees, commissions, and profits appear. In a short time, a huge share of the institution's balance sheet depends, directly or indirectly, on the 2008 housing market. This concentration of risk, however, is masked by two magic words: quantitative model. Mathematical models claimed, on paper, that the probability of a broad collapse was tiny. Estimates based on historical data proved that there would never be a nationwide decline in housing prices. Geographic diversification was sold as an unbreakable shield. As a result, securities stuffed with risky mortgages
were labeled relatively safe. A classic case of blind faith in spreadsheets. Meanwhile, leverage was exploding. To boost returns, Lehman was loading up on debt aggressively, using short-term borrowing to buy long-term assets tied to real estate. In practical terms, each dollar of equity could support more than $20, $30 in assets. While the tide was high, this looked brilliant. Profits soared, and so did bonuses. Those who questioned the risk were seen as old-fashioned, not aligned with the new reality. In the economic archives from that time, you'll find Lehman flaunting record results year after year, especially between 2003 and 2006. The bank becomes one of the biggest underwriters of mortgage-related securities in the United States. At a certain point, its exposure to commercial and residential real estate is so large that the institution becomes, in practice, a massive vehicle betting on the continuation of the housing party.
But Lehman's ascent isn't just an internal story. It reflects a much larger machine. Regulators take on a permissive stance. The repeal of Glass-Steagall in 1999 allows greater integration between commercial and investment banking, boosting the power of financial giants. Capital rules from the Basel Accord favor internal models that magically optimize capital requirements for assets deemed low risk. And guess which ones? The mortgage-linked securities rated AAA. The rating agencies act like priests in this financial temple. By assigning high ratings to complex structures, they allow pension funds, insurers, and banks worldwide to buy securities loaded with subprime crisis risk, without appearing to violate prudential rules. The irony is brutal. What should have been a brake becomes an accelerator. At the center of all this, investment banks compete in an arms race. It's not enough to make money. You have to make more than your rival. Lehman's internal culture reflects this perfectly. Aggressive targets, relentless growth, glorification of those who make the numbers happen. Anyone who raises doubts is sidelined. The environment rewards short-term wins, not long-term prudence. The high point of Lehman's ascent coincides with the peak of the housing bubble. In 2006, home prices reach historically disconnected levels from household income. Yet the machine keeps running. Even riskier products appear. Loans with no proof of income, interest-only mortgages, financing structures that collapse under the slightest pressure. The subprime crisis is being cooked on high heat, but many insist on calling it democratization of credit. For Lehman, more risk means more return. And while the world is distracted with wars, elections, and technology, the bank keeps increasing its exposure to complex real estate assets, including huge proprietary portfolios. When cautious competitors begin reducing exposure, Lehman does the opposite. It doubles down, as if it believed it understood the game better than anyone. On the surface, everything shines. Investor reports are impressive. Shares climb. Analysts applaud. Management's ability becomes a catchphrase. The institution is praised as a textbook example of modern aggressiveness on Wall Street 2008. Public perception? Strength, innovation, invincibility, not fragility. Meanwhile, the global financial system grows ever more interconnected. US mortgage-backed securities spread across European banks, Asian funds, government portfolios. Credit default swaps create an even denser web of interdependence. In theory, this spreads risk. In practice, it spreads the potential for contagion. The future global economic crisis is being prepared in silence. It's like building a tower higher and higher, trusting that the day of the fall will never come. Instead of looking at fundamentals, families' real ability to pay, the quality of mortgages, the sustainability of rising prices, attention is focused on charts, projections, quarterly returns. The worship is of profit, not prudence. There is also an important accounting element in this ascent phase, how assets are valued. In many cases, the figures on Lehman's balance sheet depended on internal models that assumed relatively benign scenarios for the 2008 housing market. As long as those models seemed plausible, nobody complained. But all it took was a change in assumptions, for example, steeper drops in home prices, for those same assets to be worth much less. Without realizing it, the institution was sitting on extreme sensitivity to changes in the environment. To sum up the ascent, low interest rates and global liquidity fuel easy credit. The housing bubble inflates prices and generates a sense of wealth. The subprime crisis is masked by complex products and generous ratings. Investment banks like Lehman leverage themselves aggressively. The global financial system absorbs these packaged risks without fully understanding them. From the outside, what everyone saw was roaring success. On the inside, fragilities were stacking up, brick by brick, until they formed a building whose base depended on a very simple assumption. The housing market will not fall across the entire country at the same time. Except that, by the mid-2000s, the first cracks begin to appear. Delinquency rates on low-quality mortgages rise. Some funds tied to these assets run into trouble. A few warnings start to show up here and there. Some smaller players are already feeling the pressure. And it is precisely at this point, when the house of cards still looks solid from the outside, but is already shaking inside, that Lehman's story turns. The phase of ascent, marked by euphoria, gives way to the phase where reality knocks on the door and demands payment. The breaking point that will turn record profits into ruin, and a bank with more than 150 years of history into the prime symbol of the 2008 crisis and the looming financial collapse.
The cracks didn't appear overnight. First, they came as small, uncomfortable signs, a few numbers that no longer quite added up, risk reports getting slightly heavier, hallway conversations dropping in tone. As with every beginning of a financial collapse, the initial feeling was that everything was still manageable, until it wasn't. Between 2006 and 2007, the housing bubble began to lose strength. In several regions of the United States, home prices stopped rising in a straight line, and in some markets actually started to fall. At the same time, delinquency rates on the lowest quality mortgages, precisely the subprime loans at the heart of the subprime crisis, shot up. That almost religious belief that the housing market never falls across the whole country at the same time started to be disproven by reality. Inside Lehman Brothers, risk models were tightened, scenarios recalculated, and assets tied to the 2008 housing market were reassessed. Securities that had previously been treated as virtually safe began to show losses. Mark-to-market accounting, which had boosted profits during the ascent phase, now ran in reverse. It corroded the balance sheet. To the public, the message remained confident. Normal volatility, a temporary phase, a brief repricing. Internally, however, anyone who understood leverage knew, when you're overloaded with debt and sensitive assets, any adverse move turns into an earthquake. At the same time, the global financial system started to feel the same tremors. In 2007, funds linked to Bear Stearns, stuffed with securities tied to the subprime crisis, collapsed. A European bank froze funds after being unable to price assets linked to US mortgages. Suddenly, doubt spread. If nobody really knew what these securities were worth, how could anyone tell who was solvent and who was standing at the edge of the abyss? Confidence, the oxygen of credit, began to thin out. Lehman entered this phase facing three lethal problems at once. First, an enormous exposure to the real estate sector. Portfolios of MBS, CDOs, and proprietary positions in commercial and residential properties. What, at the height of the euphoria, had looked like a strategic asset now behaved like dead weight. Second, an extreme level of leverage. For every dollar of equity, there were dozens of dollars in assets financed with debt. Small price drops turned into brutal losses. Third, a critical dependence on short-term funding. The institution relied daily on others being willing to roll over credit lines and repo operations. When distrust rose, that source of funding dried up almost overnight. On paper, it is always possible to argue that, in the long run, those assets would recover value. But the 2008 financial crisis did not offer the luxury of the long run. In an environment where everyone wanted to sell at the same time, the price was not what the model projected. It was whatever the market was willing to pay at that moment. And, at that point, the market wanted to pay very little. The 2008 financial crisis was gathering momentum, while Lehman desperately tried to show it still had the situation under control. At the beginning of 2008, another collapse signaled the magnitude of the problem. Bear Stearns was rescued in a rush and sold to JP Morgan with direct support from the Federal Reserve. The message for outside observers was clear. No investment bank was bulletproof. But for many inside Lehman, there was also a quiet assumption. If the government didn't let Bear go under, it probably wouldn't let Lehman sink alone. That reading, as history showed, was far too optimistic. Lehman's leadership tried to buy time. It sold assets here, raised capital there, announced cuts, and tried to convince investors, regulators, and the market that the situation was under control. In official communications, the tone was almost liturgical. Adequate liquidity, sufficient capital position, solid business model. But the share price was telling a different story. The stock plunged. Analysts began publicly questioning the institution's solvency, and short sellers ramped up their bets against the bank. Every share price drop fed the perception of fragility. Every increase in perceived fragility made financing more expensive and harder to obtain. The vicious circle was in place, classic of a 2008-style crisis in full acceleration. As the situation worsened, it became clear that Lehman needed to find a savior quickly, a buyer to take over the firm, a merger with another major bank, or some kind of explicit government support. Intense negotiations began with potential suitors such as Barclays and Bank of America. Meetings ran late into the night, spreadsheets circulated, teams pored over the mountain of assets tied to the 2008 housing market. The question repeated in different rooms and time zones was always the same. How much toxic stuff is in here, and who is going to pay for it? Meanwhile, the political climate in Washington was shifting. After the Bear Stearns rescue, public opinion and parts of Congress started to push back against new bailouts, under the banner of moral hazard. If the state always saves giant institutions, they will keep taking excessive risks. Inside the government, the dilemma was brutal. Save Lehman and reinforce the image that Wall Street lives without consequences, or let it fail and risk an even deeper shock to the global financial system. On the critical weekend of September 2008, officials, bankers, and executives gathered in New York to try to find a solution. It was a marathon of meetings, international phone calls, attempts to build a structure in which some buyer would agree to take Lehman, as long as part of the toxic assets was guaranteed by the government. But the pieces didn't fit. Barclays ran into British regulatory constraints. Other interested parties balked at the lack of solid guarantees. No one wanted to be the last one holding an institution loaded with toxic assets at the epicenter of the subprime crisis. When Sunday ended without a deal, the story was practically written. On September 15, 2008, Lehman Brothers filed for bankruptcy protection. In practice, it was the Lehman Brothers collapse, the largest corporate failure in American history up to that point. Within minutes, screens around the world flashed the same headline: the Lehman Brothers fall. This was not just the end of a 158-year-old bank. It was something bigger. From that moment on, the 2008 financial crisis had a symbol, a face, a concrete case the public could see. And at the same time, it had a trigger. Because from the moment Lehman fell, it was no longer possible to pretend that the problem was confined to the 2008 housing market or the American housing bubble. What would come next? Frozen credit markets, bailout packages, a global recession, would show that the failure of a central piece could drag the entire board of the global financial system down with it. From then on, the question was no longer whether the 2008 crisis would infect the real economy. The question became, how far would that contagion spread? In how many countries? In how many households? Over how many decades? When the news of the Lehman Brothers bankruptcy broke, many still tried to convince themselves it was just one more big bank in collapse. But what followed made it clear very quickly that the Lehman Brothers fall was not an isolated event. It worked as the visible trigger of a financial collapse that had been in the making for years behind the scenes of the global financial system. In the very first days after the bankruptcy filing, something essential began to fail: confidence. Ultra-short-term investment funds, the ones companies use to park their cash, started to face massive withdrawals. Investors, terrified at the idea that any institution might be exposed to the subprime crisis, began pulling money out of everything that had previously seemed far too safe to ever be a problem. Suddenly, companies that depended on those funds to pay wages, suppliers, and basic bills found themselves facing the prospect of not having liquidity. The 2008 financial crisis stopped being an abstract issue of balance sheets and entered the day-to-day reality of the economy. At the same time, banks started to look at each other with open distrust. If a name like Lehman, with decades of history on Wall Street in 2008, could go under from one day to the next, who else was hiding losses tied to the housing bubble and the 2008 housing market? Interbank credit lines dried up, short-term interest rates spiked, agreements that had been automatically renewed were suddenly questioned. The short-term funding mechanism that sustained the leverage of several investment banks began to seize up. And in a system where the daily flow of credit is like the blood that circulates through the body, that seizure is a sign of multiple organ failure. While the Lehman logo appeared on every front page as the symbol of the 2008 crisis, another name stepped into the spotlight: AIG, one of the largest insurers in the world, drowning in derivative contracts that functioned as insurance on securities tied to the subprime crisis. If AIG also failed, the web of broken contracts would be devastating. This is where the response changed tone. Unlike what happened with Lehman, the US government decided to intervene heavily to prevent AIG's collapse. That difference in treatment reinforced a strange feeling. Not everyone would be allowed to fall, but there was also no clear guarantee of rescue. The uncertainty became even more corrosive. Faced with the risk of a complete paralysis, the TARP program was announced, a multi-billion-dollar bailout designed to inject capital into banks and stabilize the system. At the same time, the Federal Reserve cut interest rates close to zero and began buying assets on a historic scale. The 2008 financial crisis pushed central banks into territory that until then had been seen as extraordinary. It was an attempt to prevent the emerging global economic crisis from turning into a new 1930s. But when we look at the economic archives from that period, we see that, by then, the crisis had already crossed the Atlantic and spread across Europe. European banks were carrying large amounts of securities tied to the American 2008 housing market on their balance sheets, many of them rated AAA and supposedly bulletproof. Now those securities were worth much less, or almost nothing. European governments were forced to step in, nationalize institutions, and offer public guarantees to calm depositors. The 2008 crisis, which began with mortgages taken out by low- and middle-income American families, turned into a problem for sovereign states, global stock markets, currencies, and, shortly afterward, public finances. From that point on, the 2008 financial crisis fully transformed into a global economic crisis. Companies stopped investing, cut projects, postponed decisions, downsized their staff. Unemployment rose in several countries, especially among young people. Indebted families, many of them lured by the promise of easy credit at the peak of the housing bubble, lost their homes in mass foreclosures. Entire neighborhoods in the US were marked by empty houses, boarded-up windows, for sale and foreclosure signs. The narrative of credit-fueled prosperity, the one that had sustained blind optimism in the 2008 housing market, now revealed its cruelest side. In Europe, the situation gained another layer. The combination of bank bailouts, falling tax revenues, and rising social spending blew huge holes in public accounts. In a short time, the focus shifted from Wall Street 2008 to the periphery of the Eurozone: Greece, Portugal, Ireland, Spain. A banking crisis turned into a sovereign debt crisis. The response came in the form of harsh austerity programs, spending cuts, and unpopular reforms. The global economic crisis stopped being just about derivatives and mortgages and became about frozen wages, strained public services, labor reforms, and young people emigrating in search of opportunity. Meanwhile, central banks kept applying ever greater doses of extraordinary medicine. Zero interest rates for years, ongoing asset purchase programs, international liquidity lines. In theory, this was the way to prevent a long-lasting systemic collapse. In practice, these measures also had side effects. They boosted financial asset prices, fueled new cycles in stock and housing markets, and widened the gap between those who owned assets and those who depended only on wages. The 2008 financial crisis, ironically, ended up reigniting debates about inequality that would shape global politics in the following decade. On the social and political front, Lehman's collapse and the subsequent rescues of other institutions left a deep scar of mistrust. In the US, the contrast between banks saved with public money and millions of people losing homes and jobs fueled protest movements in opposite directions. On one side, movements like Occupy Wall Street. On the other, political forces that tapped into resentment against experts, technocrats, and the system. In Europe, the combination of a global economic crisis and austerity produced a wave of discontent that opened space for anti-establishment, Eurosceptic, and populist parties. On both sides of the Atlantic, the 2008 crisis became a psychological milestone, the moment when many people started to see the global financial system as a game in which losses are socialized and gains are privatized. If you go back to the economic archives of official speeches from that period, you'll find a recurring expression: lessons learned. Regulators toughened capital requirements, talked about stress tests, and tried to increase transparency around derivatives. Laws like Dodd-Frank in the US were presented as responses to the 2008 financial crisis, with mechanisms designed to deal with institutions considered too big to fail. But beneath the surface of these reforms, much remains troubling. The logic of short-term incentive structures in investment banks, the world's dependence on cheap credit, the natural tendency to chase high returns in low-rate environments, all of that remains embedded in the structure. In the end, the Lehman Brothers bankruptcy was not just the end of a historic bank. It was a revealing, almost didactic moment about how the global financial system really works. It showed that a sequence of decisions taken over many years, deregulation, overly optimistic risk models, the unchecked expansion of the housing bubble, blind faith in the market's ability to correct itself, could result in a global economic crisis capable of impacting people who had never even heard of CDOs, MBS, or derivatives. And even after all of that, one uncomfortable question still hangs in the air. Did the world really change course after the 2008 crisis? Or did it just tighten a few bolts while keeping, at its core, the same kind of machinery that once allowed the subprime crisis and the Lehman Brothers fall to almost bring the entire building down? It is precisely when we look at that question and try to recognize what is repeating itself today in new bubbles, new credit cycles, new waves of market euphoria, that Lehman's story stops being just past and starts to draw dangerously close to the present again. End emphasis. After 2008, many people wanted to believe that it had been the crisis of our lifetime, something so big it would never be repeated. Regulators tightened rules, politicians gave solemn speeches, bank executives appeared in hearings under public pressure. But if we look carefully at what happened after the 2008 financial crisis, it's hard not to notice an uncomfortable pattern. The system learned, but did it learn enough? One of the immediate responses to the 2008 crisis was to flood the world with cheap money. Interest rates close to zero, massive asset purchases by central banks, abundant credit to prevent an even bigger collapse. That certainly stabilized the patient, but it also created a new environment, more than a decade in which the cost of money was artificially low. In that scenario, investors started chasing anything that promised slightly higher returns. And wherever there is spare money hunting for yield, history shows that bubbles are not the exception, they're almost inevitable. That's how, over the following years, we saw new waves of euphoria. Tech stocks trading at absurd multiples, emerging markets receiving huge capital inflows, housing prices rising again in several countries, cryptocurrencies exploding in value, companies with no real profits worth billions on the stock market. In many cases, the reasoning sounded strangely familiar to what we heard before the 2008 housing bubble. This time is different. The old model doesn't apply. The traditional indicators don't understand this new reality. The same overconfidence, wrapped in modern packaging. At the same time, the structure of the global financial system became even more interconnected, with chains of public and private debt stretching across continents. Governments that spent heavily to combat the effects of the global economic crisis, and later, shocks like the pandemic, emerged on the other side with historically high debt levels. Companies took advantage of low interest rates to leverage themselves. Families, in several countries, once again took on heavy long-term financing. It's as if the house rebuilt after the storm had reinforced walls, but was still standing on ground that keeps shifting. When interest rates started to rise again, especially from 2021 to 2022 onward, to fight a resurgence of inflation, the bill for that long period of cheap money began to show up. Long-term bonds lost value, some regional banks felt the hit, highly indebted companies became vulnerable. Once again, the common thread is the same one we find in the economic archives of 2008. Decisions made in an environment of abundant credit, revealing their fragility as soon as the wind changes direction. Another uncomfortable connection with the 2008 crisis lies in the culture of risk. Even though the rules have been tightened, the logic of rewarding short-term results is still very much alive in many parts of the financial sector. Bonuses pegged to immediate profits, pressure for quarterly performance, competition between managers and institutions. The temptation to push the limit remains. Complex products keep being created, often understood by few and bought by many. To the end investor, the pitch sounds familiar. Above average returns, controlled risk, seals of approval that faintly resemble the AAA ratings before the subprime crisis. On the geopolitical front, the post-2008 financial crisis world has also changed. The rise of China, tensions between great powers, trade wars, energy shocks, the partial deglobalization of supply chains, all of this makes the environment more unstable. In such a world, any structural fragility in the global financial system can amplify economic crises, spreading local shocks far beyond their original borders. What once seemed like just a Wall Street 2008 problem now coexists with powerful financial centers in Asia, the Middle East, and Europe. The board has become more complex, the interdependencies more delicate. And then there's the psychological aspect. The memory of the 2008 crisis marked a generation, but experience shows that economic memories fade. Part of today's market is made up of people who were children or teenagers when Lehman fell. For many of them, the story of the Lehman Brothers collapse is something from a book, not a personal scar. That creates room for old mistakes to show up with new makeup. Innovative assets, narratives of unlimited growth, confidence in the argument that, this time, the models show it's safe. The same temptation, in different wrapping. Looking at all this, the story of Lehman Brothers stops being just a closed chapter in the economic archives of the global economic crisis. It continues to function as a mirror. Remember that, before 2008, there were also optimistic reports, assurances that risks were under control, and the belief that risk management tools were more sophisticated than ever. Today, with new technologies, algorithms, artificial intelligence, blockchain, and even more complex derivatives, it's easy to fall for the illusion that now we finally dominate risk. But the fundamental logic, leverage, credit cycles, euphoria, and fear remains the same. The real connection with the present, then, is not just in comparing 2008 charts with current ones, but in recognizing the patterns. Moments of excessive confidence, periods of cheap credit, concentrated bets on a single type of asset, blind belief that everyone's doing it, so it must be safe. It was this chain of factors, combined with political and regulatory choices, that pushed Lehman over the edge and almost dragged the entire global financial system with it. And echoes of that same chain can still be heard today in debates over new bubbles, new vulnerabilities, new systemic risks. In the end, the question that the story of the Lehman Brothers bankruptcy throws at our present is not just, how was that even possible? It is, above all, knowing what we now know about the 2008 financial crisis, the subprime crisis, the real workings of the 2008 housing market, and the 2008 crisis. Are we really doing something different? Or are we just trusting that, if another problem comes, someone will flip the bailout switch again and push the bill once more into the future?
After everything that happened in the 2008 financial crisis, with the Lehman Brothers collapse almost pushing the global financial system to its limit, do you think the world truly learned anything? Or are we just kicking the can down the road, waiting for the next collapse? Because if history teaches us anything, it's that every crisis leaves warnings. The real danger is believing those warnings no longer apply. So the question is not whether another shock will come. It's whether, this time, we'll be prepared, or once again caught in the illusion that the system is unbreakable.